Hello traders, it's Tuesday, January the 28th. This is John Kicklighter, Chief Strategist for dailyfx.com. Here with your FX market wrap-up for the opening 24 hours of trading this week, as well as an outlook for what we can expect in the next 24 hours, and certainly looking beyond that because the major event risk is spread throughout the week. Now, this opening 24 hours is a significant contrast to how we ended last week when we were seeing a substantial upgrade of risk aversion, which began in the emerging markets and spilled over to the traditional capital markets, including the S&P 500, one of my favorite risk measures there. But if we want to see a consistent and overpowering risk aversion theme, that would cater towards record levels of leverage, which I updated today. We'll see that today, as well as the extreme position or extreme exposure that investors have ahead of major event risk, then we need to see it really escalate. We need to see that commitment, that conviction across various asset classes. But as of right now, it's still in the lower echelons, lower threshold of pain. Now, looking at our benchmark for the risk aversion we've had this past week, and certainly is going to be our most imminent risk this week, we have the USD, or US dollar Argentine peso exchange rate, or the USD ARS. And you can see the dramatic performance it had through last week. Thursday was actually the peak day, over 13% increase in that exchange rate. Friday was materially weaker, although you can see that on a historical basis, still an exceptional advance. And Monday was more of a moderation tone. Right, this moderation tone, this pullback in the emerging markets, was a substantial relief across the board. When we looked at other measures of risk, they were equally relieved of the circumstances. All right, S&P 500, the Nikkei 225, notable technical holds on both series. All right, actually, I haven't made it very prominent, but there is a very substantial trend line there, internal trend line here. All right, so there is a nice hold in the equities market. The yen crosses, which we were talking about on Friday or Saturday of this past week, are the most sensitive of the risk currencies or risk pairings in the FX world. Those two would look to some level of stabilization. Euro yen and pound yen coming back over the necklines on their respective head and shoulders patterns, and certainly the more dramatic performances of the higher yielding carry, Kiwi yen, CAD yen, and Aussie yen, would all see more substantial recoveries. All right, net, this was a rebound for risk trends. So all those things that we discern as risk sensitive, anything in this measure here, is going to see the relief bounce that we had on the session. All right, obviously, we're talking about U.S. and global equities, emerging markets, carry trade, risk-reward index, my own risk-reward index, and, of course, the commodity performance. Now, the commodity markets were also enjoying some of the speculative return, but we didn't necessarily get a lot of the rebound through the past session. Both gold and oil were seeing a pullback, and this is an imbalance that we will see throughout the markets, and it's something I wanted to highlight, and something I did highlight earlier a little bit in the strategy video today, which is talking about the ebb and flow of risk trends, which is going to be very important this week as we move from major event release to major event release, and this can act as kind of a trigger to sentiment themes. But in looking at the relationship here, this is a risk severity curve, all right? And all it does is tell us how market moving and how pervasive risk trends can be and where we're at on that curve, all right? So along this curve, as we move left to right, we're talking about the severity of risk aversion. As markets become more and more risk adverse, it has a greater and greater market impact. All right. Now, at the very low end, we have a few instances of volatility events, and generally there's a low correlation. This is something that I think is still present in these markets. That's why the Aussie USD, traditionally a currency pair that aligns itself to carry trade, has not been showing a particularly strong correlation to something like the S&P 500, which is still driving up on stimulus. All right, this is a good level of measuring a low risk aversion kind of sentiment, and it could even be into positive sentiment or positive risk appetite. The next level up is frequent volatility events. You have more regular swells in volatility, and it can even be a swell in volatility for a major market. So like the S&P 500, which did have quite the volatility event this past week. Big drop. All right, the risk aversion theme was certainly very strong there. We have one of the strongest drawdowns we've had in a number of months. All right, so we're starting to get into this level. We even got so high as to see a concerted unwinding of riskier assets where we have more of a moderate correlation. All right, this is why we started to see emerging markets drop off, the benchmark equity indexes, the yen crosses, the more sensitive, risk-sensitive carry currencies. All right, all of these markets, including treasuries, were all making that risk-based move. All right, that moderate level of correlation, though it wasn't a shared level of commitment, is a sign that we're moving up the risk theme. However, we have yet to meet this next stage. This is a concerted unwinding of all risk assets, and a high level of correlation that includes momentum. All right. If we were at that stage, the U.S. dollar would more likely than not see a rally as a safe haven currency. So for currency pairs and the more liquid currency pairs, we would be seeing a Euro USD drop to the downside, a Pound USD drop to the downside. All right, but for right now, those themes that have pervaded pound dollar, interest rate expectations for the British pound, are outpacing something like safe haven demand. For the Eurozone, we have the capital inflows into periphery Eurozone debt. So Spain, Italy, Portugal, Ireland. The appetite for those higher yielding bonds is still more important than risk aversion. So we have not had a pullback in these particularly liquid assets. So you can tell in the severity curve where we're at. We are certainly at this level at least, more than likely a little bit higher, but we have not seen a pickup to the level of risk aversion that would tell us that we are heading for a potential financial instability event. All right, and that's where we get up into the highest echelon when we get into full-scale deleveraging and we start to get a liquidity or a cash crunch. All right, can we still have this this potential scenario? Absolutely. All right, we should never write off any scenario, but in terms of probability, it's a lower probability that we get up to here. It's not necessarily that low of a probability of getting to this severe level or level of severity, and truth, this is where you're going to get your happy medium for a drop or a reversal, a bearish reversal in capital markets, and develop more of a trend out of it. All right? When you hit the severity of a liquidity or cash crunch, yes, you're going down and you're going down fast, but that kind of movement generally leads to a response from policy officials, a coordinated response, or it has in the past, and it will burn itself out relatively quickly. All right. But we know we have the backdrop conditions for this. As I said in the beginning, we had an update for December leverage, New York Stock Exchange leverage, and that is money based on margin accounts versus the debits that they have in their accounts. And the difference is at record highs. All right. So they're using record levels of leverage. We know that in general, the risk level in these markets is extremely high. We haven't had a 20% correction in the S&P 500 in quite a long time. All right, way back since the financial crisis ended. And we know that there are very real reasons to be concerned about the stability of the liquidity market or the cash market in some of the major financial regions of the world. And particularly, we're talking about the Eurozone, where they consistently wear down the ECB's balance sheet. Why is that a problem? Well, with a reduction in the balance sheet, that means there's less liquidity out in the system, and there is less of a central bank presence, and subsequently interest rates on the market start to rise, right? Because there is less of that liquidity out there. So we start to have more expensive loans. That's a dangerous proposition for countries that are struggling to recover from a recession, that are just barely passing their stress tests, and even a number of them that might be hiding or not fully accounting for risks in the system. All right. But there are certainly reasons to be concerned about liquidity in the U.S. market, though this will really pick up when we're talking about a demand for just outright liquidity concerns. We have the Asia session, the Asia market, where we were talking about the Chinese repo rate, and that has pulled back as well, especially because we had that lingering uncertainty with the trust coming to maturity at the end of this week. That has been resolved, it seems, but at the same time, there is just one of many problems that underlie the Chinese market. And of course, we always have to be aware and cognizant of the risks that linger in the emerging market. All right? So there's a lot of uncertainty out there. And it's easy to signal or set off the uncertainties that these risks present. However, you need the proper catalyst, because these are long-lasting trends, long-lasting risk build-up trends. And to shake that complacency and to really just genuinely reverse such a prominent trend requires some serious fundamentals and a focus that reverses those sentiments. All right. So looking at the docket that we have ahead, I know that we have a very dense week worth of event risk, and we certainly have potentially the catalyst that can make a more tangible and measurable jump in the risk assessment, but it's likely that we are going to wait it out, all right, until the FOMC rate decision on Wednesday. Now, the primary expectation is that this ends with another taper, the second one after the December 18th taper, and that is not going to be likely a good outcome for the markets. Now, when we look at the dollar's performance after the last taper, it didn't really move very far. All right, and more specifically for the S&P 500, the response to the taper was actually continuation to the upside, whereas previously the absence of tapers still led to this market to decline. All right, I don't think that we're going to get the bullish response this taper around, especially when the markets are just simply looking for a reason to be bearish. They already have the lean; they just need the justification. So we have major event risk ahead, and it can quite possibly set off fear bells once again, or alarms into the market. But we have a waiting period. All right. We have, of course, Monday was the lull of the week. Things are really going to start picking up on Tuesday, but they still are not the same level of severity, the same level of market impact as what we're going to see on Wednesday. Now, we can always have an emerging markets crisis arise again, and that's a very high probability given the circumstances of last week. But we have to run with what we know is going to be there, and be prepared with strategy and trading approach if we do have the unforeseen. So looking ahead to the next 24 hours, we'll definitely keep our eyes up and zoned in on risk themes. I want to look for a level of severity. So while you can look at something like the dollar Argentine peso, the dollar SAR, the dollar real, all right, the dollar Indian rupee exchange rates, all those exchange rates that measure the emerging markets, really pay attention to see how much of that fear, that risk, spreads into the standard market. All right. And there's going to be, of course, the S&P 500 is a great measure of that, especially given its relative position with approximate support levels. You have a number of internal trend lines. I also have here the 100-day moving average, right, in the green. There is a lot of collective support down here. If this breaks, this is absolutely a good signal from a technical perspective that risk aversion is continuing. It does not necessarily say we're going to have strong momentum to follow it up, but it's the next stage of decline. easy to follow in those footsteps is going to be the yen crosses. All right, things are getting a little bit risky with the yen crosses because we see a decline. And if risk aversion continues to burn, then you're going to have a very large hole of doubt in the Bank of Japan's efforts to keep this currency under pressure. In fact, we are already seeing that the dollar yen is clearly diverging off of the path of steady appreciation or yen depreciation, like it did from the beginning of November into May of 2013. So November 1st, 2012 to May 31st, 2013. All right, here's this current year's performance, and as you can see, we are not seeing that same level of conviction. All right, we are not seeing the same level of buildup that we had into the first open-ended QE program from the Bank of Japan. All right, this is a concern, and it should be a concern for the Bank of Japan because they have to keep the expectations going. It has to be built on speculation, market performance, because realistically speaking, the Bank of Japan does not have the liquidity to offset a market that is focused in on risk aversion. Does it necessarily mean that the Bank of Japan is going to step up its effort? Unlikely, because they probably know they won't win that game. All right, but this is a very sensitive currency pair, and I will be keeping the euro yen specifically in my sights to see if we do have that continuation. So if we have one step up from risk aversion and from emerging markets to the more sensitive, like the S&P 500 and the euro yen, I like the euro yen. Right, these yen crosses. Now, of course, we can also see an escalation to full-scale risk aversion, which I don't think is necessarily a high probability into the next 24 hours. But if that's the case, the euro dollar still has that great setup. If we can get below this, I had to move down now the support down to 136.50 because it did slip a little bit this Friday support, but not with any kind of follow through. I still think this has great potential in the short term, medium term to long term. I'm going to be looking to see it drop below that 135 level and really make something out of that initial technical decline there. All right. Now, if we don't want to run on risk trends, which we have to have a plan for because risk on, risk off ahead of the Fed rate decision is going to be difficult to not just jumpstart but sustain. All right, that doesn't necessarily preclude the possibility of trade setups. Now, we do have some noteworthy event risk, including the European Union Finance Ministers meeting. We have the U.S. Consumer Confidence Report, as well as durable goods. We have the Portuguese Economy Minister talking about foreign investment to that country. This is particularly noteworthy. If you're a Euro trader, watch this, because this talks about one of the troubled bailout countries, that how successful it's been in drawing in capital. But really, the market mover is going to be the UK GDP figures. All right. As I was talking about earlier, the pound has not given up a lot of its gains, all right, against most counterparts, but particularly the US dollar. And that's because we haven't seen risk aversion hit the kind of cadence that it will offset the expectations for a near-term rate hike from the Bank of England. Now, when I say near-term, I'm not talking about next month. I'm talking about sometime in 2014, which is ahead of the Bank of England's timetable, and given a market that pays attention to interest rate forecasts, which you know the FX market does, this is very important. If we see a GDP drop, this could be something that undermines what has essentially been a very hawkish expectation, a very hawkish outlook. There's a lot for the pound, in other words, to lose if the data does deteriorate. So keeping an eye on the pound dollar at 65 and then down here at around 63.50, that is a interesting possibility. Now, of course, this also has its ties to risk trends, but this correlation to risk on, risk off has not been very good. It's been much more sensitive to monetary policy expectations, and we do have the high probability of a taper on Wednesday. You can look to the euro pound. After it had its bounce back up to 83, it held, and now it's starting to move back lower. This is probably a better play out if the pound is to see more significant strength. Why? Because the euro's fundamental forecast is looking even more bleak. Now, if we do have a strong GDP figure, the markets might just be looking for a reason to continue this move to the downside after that false break reversal. All right, it could still turn into a genuine break, but we see a lot of these kind of movements, especially in these levels of extreme volatility. One pair that I would stay away from unless there is explicitly risk aversion is the euro yen. All right, you have to align a pound selling as well as risk aversion, otherwise this is going to be a confused currency pair. The two very interesting pound-based pairs that I want to point out, we'll start here with the pound Aussie. This one is known for extreme volatility. We are at the 38.2 fib of this 2008 to 2013 bear wave. All right, that is just above us at about 192.50. So we have a good, large resistance up there. Now, continuation is the more probable outcome, the more supported outcome by momentum, but as you can see, we've had some congestion candles develop, nice dojis. So be very careful about this. The one that really interests me from a technical perspective, this pound Kiwi. Now we have an ascending wedge. We have a triple top. You can call that a head and shoulders pattern, but head and shoulders are a reversal pattern. What really are you reversing here? Just a different range, I guess. So it doesn't really meet my standards for a head and shoulders pattern, but it's a nice triple top, rising wedge, and much longer term, this is a big decline with a head and shoulders pattern. All right, so there is a short, medium, and long-term element to this technical pattern. From a pound Kiwi perspective, the New Zealand dollar is looking at a very fantastic interest rate forecast, and the pound has been able to offset that. The RBNZ meets on Wednesday, so you have to be very careful about this. But if we have a disappointing UK GDP figure to pull the pound down, the New Zealand the New Zealand rate decision on the following day can make this a very exciting pair for multiple potential trades. Of course, you have to play it close to chest. You must be very cautious in your approach. Make sure you trade these fundamentals, this news, with a reasonable strategy and reasonable targets and stops. All right, but there's a lot going on in these markets. It's best, though, that we keep our focus. We have to keep our focus on the event risk that we have coming up. All right, this next 24 hours is dominated by the UK GDP figure, which is not a ideal full-scale risk aversion kind of scenario, or risk on, if you will. The following session, however, has the FOMC rate decision, which can absolutely hit that kind of scale. So until we do have a full-scale risk aversion theme and an upgrade to this severity, all right, we must set our trades with reasonable expectations. All right, watch our benchmarks and watch the level of risk tolerance in the markets as it prevails. All right, I'll update you once again on these markets tomorrow. In the meantime, good luck trading.